Ladies and gentlemen of the crypto space, we're live on a Monday, April 25th at 12:19 p.m. And boy, oh boy, people are trying to understand what the heck is going on in the markets, why people are doing what they're doing. And I like to remind myself that this all reduces to base human market psychology. Humans are quite predictable, and they have greed, they have fear, they have envy and jealousy and all that shit that they teach us in school about people what people's motives are and the meaning behind behavior, action, so on and so forth. And when you look at these markets from that perspective, you really get a sense of what people are thinking, why they're thinking, and he gives you insight into not just directionality, but the state of society, the stability of society, and it's not really stable. And if you get ahead of these known factors in human behavior, you really start to understand why the market goes up, why the market goes down, so on and so forth. So we're obviously in a relatively bearish market, and we'll pop it over to the main screen. Why don't I have the US 10-year up? So the bond market is bullish today. Low chart, US 10-year. So it's bullish. It's falling back down below the 41-year trend as well as the 200 EMA. This is a precarious time if folks are in the market for purposes of capital gains. Capital gains meaning the price of assets nominally price going up. And now I could appreciate there's two methodologies for interacting with markets, capital gains as well as in it for the tech or ownership or voting rights and revenue streams, which is really what I focus on. So the psychology of markets. I'm trying to paint a picture of this, what I was trying to convey with the title of the stream, and let's see how well it comes together today. So in bearish markets, capital gains is a scavenger's game. Any time participants come into a particular asset after you do, you take it. And that's ultimately the way it is in a bullish market as well, except in a bearish market, there's much less liquidity. So there's much less capital gains to be extracted from market actors that you have been able to front run. Now, I'm not a fan of really looking at markets like that nowadays. Now, clearly, historically, I have engaged with markets like that, which is why I've been able to achieve what I've been able to achieve. And from time to time, that is something that's considerable, albeit most of the time nowadays, I don't really think about markets like that. I mean, obviously, the most liquid market like an Ethereum or Bitcoin, if you see an extraordinary trend setup, you're able to capitalize on it. But the problem is the trend setups are not something that I'm not interested in at the moment. So capital gains is not a perspective that I think is quite reasonable for these markets currently. So my mentality currently revolves around, uh, you know, ownership of revenue streams of businesses and modeling these systems as businesses. I know how much cash flow my businesses generate. I expect these businesses to generate less cash flow, and that's exactly what the Fed wants. The Fed wants us to experience a period of austerity where we have less income, we're able to buy less things, so on and so forth. And this is their historic playbook to cure inflationary pressures, consumer price inflationary pressures. Now, that's okay. I'm willing to entertain and accept that reality. I'm not too interested in the principal valuations or the dollar value of the positions which are my businesses. So this is the whole pizza shop narrative I've talked about. So this is a time where I reflect on the stories I've told over the last 2 years, and I think that narrative is more meaningful, and it comes to me with more context nowadays because I have all this history of interacting with these markets. The last bullish cycle, which started probably early 2020, and reminiscent always of past cycles. Um, and past cycles were literally only capital gains. There was nothing to past markets. There was no meaning, no soul, no opportunity other than capital gains. There was no voting. There was no ownership. There was no governance. There was no nothing. It was It was trivial and shallow. But now I rest quite comfortably knowing the positions that I have are representative of actual businesses that have cash flow. They might as well be stocks and companies, but they're not, because stocks and companies have been perverted to the point where they're completely useless to a person like me who looks at markets as I describe. Stocks give you no voting rights, no meaningful voting rights. They're entirely marginalized. There's literally useless cash flow. You have no exposure whatsoever to the cash flow of the business, only the leftovers after salaries, after expenses, so on and so forth. These companies literally give leftovers, and there's no potential to really own a meaningful part of the business. So I guess in that regard, what we've entertained in the DeFi space over the last 2 years is a good part venture capital, where you're able to acquire a meaningful percent ownership of these businesses such that you have exposure to a meaningful percent of the business's cash flow. Quite interesting. I guess as much as I loathe what has become of the stock market with regard to dividends, so on and so forth, it is ultimately, in many regards, the same manifestation in the crypto space, except that we were early and we were able to purchase, from a venture capital standpoint, a meaningful percent ownership of these businesses, and which we can't do in the stock market. We don't have hundreds of millions and billions of dollars to buy, 1% of Apple or whatever stock is paying a half a percent or 1%. If you own 10% of Apple, you're not getting 0.5% return on your money. You own a percent of the revenue stream. Whole different classification of investor at that point. What do we got today? 18 people in the stream, 4 likes. Yeah, we're in a bear market, boys and girls. We'll try and figure out together, as always, how best to prepare for better times. The most important thing I know for a fact, because I've been through bad times and good times countless times, is that look, we see the numbers on the stream go down. We see the interactivity on social media go down. This is the time. This is the time. This is the opportune time to position yourself to understand what these markets do. Could you imagine if I or you or if anyone was well prepared in late 2019 or 2015, heading into 2016 and 17? Oh my God. And that's right now. This is the most exciting time. I watch the 10-year find resistance. I watch the yuan completely rip to the upside. I watch the DXY and the S&P crater. Well, DXY ripping because that's euros and yen. And yen, the yen, the euro, and the yuan. Wild. And there's plenty of folks that follow Forex much closer than I do, but I look at these particular fiat currencies. They give me a very broad sense of the market. Imagine the understanding we have now, and I speak for myself, the understanding I have now of the markets, how prepared I would have been in late 2019. Absolutely wild. It would have been multiples more gains to be had. And that's where we're heading. So as folks are bearish in these markets, sure, the price point goes down, but the technology is extraordinary. The venture capital opportunity is extraordinary. The revenue streams are extraordinary. If you succeeded over the last 2 years, you've preserved adequate positions to generate entire salaries. It's why I talk about, you know, crypto to Gemini to BlockFi. It's a salary. And everyone's going to have a different degree of success over the years. So maybe it's $50 a week. Maybe it's $5,000 a week. And you probably fall within that range. Clearly, you're not making $0 a week. Everyone that listens to me is making some kind of revenue stream. And the goal and the art of navigating this DeFi space is to make it sustainable, protect the principal valuation, own the right things that are or establishing themselves as infrastructure, which is basically lindiness. Lindiness entails if a technology, what's the odds of a technology existing in the future? The longer it exists, the more likely it is to exist in the future. So that's what we look for in these protocols, these properties that are likely to say, hey, I'm Lindy. I'm Lindy. So we know the protocols, and I don't really like talking about specific protocols. I don't like, the general public hearing what I say and getting the temptation, like, without due diligence to make decisions. So that's why I really hesitate away from talking about protocols nowadays. You all know the protocols that I like. We clearly talk about on Discord these protocols, and we talk about other stuff and trying to spread out on the curve a little bit. But nowadays on social media, on Twitter, I shy away. I mentioned synthetics this morning on Twitter. Man, that was a ride in 2020. 70 cents to $7 was something that I played, and nowadays, look at the price point. It's five and change. It was as high as 20s. I think I have the synthetics chart up. Let's take a peek real quick. I mean, this thing is Lindy as fuck. It was around. It's been around. It's gonna be around. The question is, where is it heading? Now, price point, can it go lower? Sure. But the Federation is building. That's quite interesting. What has become of optimism. There's protocols that are consuming synthetics now, and I'd like to see the bribes go up. They started bribing, and if what'll happen is, as they're bribing on Curve and Convex, they'll see the results, and as they see the results, they'll be like, "All right, I'm going to bribe some more," and that'll get deeper SUSD liquidity, and then the spiral and the flywheel effect occurs. It happens to any protocol that starts to play with the curve mechanic and to achieve deep liquidity. It's just the natural direction of all protocols once they experience what Curve offers. Quite extraordinary. So I'm not tempted really at all to take positions right now. Uh, Citadel is probably the only thing that's on my mind in the short term. I did take a little bit of a Rook position. They just relaunched. It's no longer Keeper DAO, it's Rook, and it's a whole different thing. It's what I was really hoping to see back in early 2021, but it just wasn't back then. And they admit, even in their Medium documentation nowadays, that they were understaffed and it wasn't really well maintained, and they barely had enough resources to keep the lights on, yet alone move the protocol in the right direction. But that's not where they are now. It looks like FTX is stepping it up, probably behind the scenes with resources, considering everything that we saw about the protocol, what it's capable of, and really where it's going to be used for with regard to catalog. And I'm sure FTX has its eyes on catalog because that's literally the directionality of the entire trading infrastructure is away from their centralized implementation on FTX and towards some sort of on-chain implementation, and that's has the vibe of catalog written all over it. And obviously catalog uses the dark nodes, and catalog is going to use Rook for MEV protection and efficient swaps. So this is a heck of an ecosystem between the three. Now, it wasn't a large position. I think it was two and change, 2 point something percent of the portfolio. Small allocation, still sitting on 25 plus percent cash. And the cash is productive in most regards. About 25, 30% of the cash is on Frax, cranking out like 25% returns. Revenue stream there. I threw a couple of bucks over on uh, USDC Day, Deuce Finance on Beethoven. I threw a couple bucks on Key Dow with my four pool, whatever they have on Optimism. So when Key Dow launched on Optimism, they're throwing some incentives around. So I think that's around 15%. Throw a couple bucks in there. Um, so that's about it. I'm not overwhelmingly active right now. I'm just passive, trying to understand and have these types of conversations like I'm having with you guys right now about the market to try and assess, is there really anything to do? What are my goals? What are my objectives? And I don't really want I don't want the risk of capital gains exposure because the odds are it's going to be capital loss. So I don't want assets that can be bought or sold because then you got all the emotions associated with, am I going to buy it at the wrong time? Am I going to sell it at the wrong time? And that's not this type of market. You know when that type of market is? Look, you see the green candles on the weekly. When you've got candles going up on the weekly like that, you don't have to worry about really did you buy at the right time? Because next week it's going to be up, and then you're in the green, and then really the only emotion you have to deal with is selling something that's going up. So bullish markets are going to be interesting the next time we encounter them, because you know I need to remind myself, and I will remind all of you guys, you sell when you think it's going to keep going up forever. And if you're able to lock in 1, 2, 300% profit, that's crazy. That's crazy. People sitting holding this shit for years. I know time in the market beats time in the market, but if you could crank out 1, 2, 3, 400% profit in a couple weeks' time, that's crazy. That's absolutely wild. If you get in 25% on cash and it's denominated in fracks, and that fracks rips 400%, that's crazy. So I don't know. I have a bit of a disjointed story for you guys today, because I'm just sitting here relaxed trying to digest the market, clearly not actively engaging in it, but I don't know. I gave you guys the best story I got today. I've had better introductory monologues before. They will be back. The better monologues will be back. But let me see if I can help you guys with any questions on this Monday. Risky Cryptos in the house. Ron Skipitsky, my man. Greetings from Cyprus. Oh, my goodness. I'm sure you probably have a really nice view around you, or there's a really nice view a couple of kilometers away. God bless. Raul, hello. One curious view. Hey, hey, Muhammad, hello. Great dad speaking. To be fair, I've got Crypto Yogi in my office watching with me. It's a pleasure. Lives in the house. How are you? I'm okay. I'm I'm very passive mode. Like you see me a little light in Discord. I'm a little light on social media, on Twitter, but it's all bearish stuff. I'm talking about the realities of the market. I mean, this chart is crazy. They literally, but it's China. They have a peg, so they literally are devaluing their currency. By devaluing their currency, they make it stronger, or they get it aids in their capacity to service debt. It aids in their capacity to pay things domestically. So it's anyway. Currencies are complicated. I'm not going to digress too much into them. But point being, I'm staring at these charts and I'm like, there's not much to do. The system is heading in a bearish directionality. There's no capital gains opportunities. I'm not a scavenger. I'm not in the markets for that, and I'm just relaxing. That's how I'm doing, Liv. I hope everything's good with you too. Mike, the people that are still in crypto will be told they were lucky for buying cheap. Probably. Um, it's still imperative to know what to sell and to know what to hold on to. I have literally no assets that can't be sold. Everything that I can sell has been sold. There's nothing in the portfolio that isn't part of some sort of larger narrative or position that is really not 2017, not 2018. The stuff that I have is not capital gains. The stuff that I have, it was VC ownership of a company, of a business that pays you weekly, that you could literally transfer to a credit card and pay bills. Could go out to the Subway shop or eat dinner or pay your car bill or pay your mortgage. It pays you weekly. Straight up VC over the last 2 years. Absolutely wild. Eris, hey Noah, do you have a mental timeline for potentially what the next 10 years for macro may look like? Yeah, regime change, 10-year most certainly. I would say these systems don't hang on for 5 years. This plays into what China's doing with their CBDC, what every damn country around the world is doing with their CBDC. There's a reason they're doing it. Because they need more control over the monetary policy to facilitate stuff like UBI, and they need control over the inflationary and deflationary pressures in the system. And they can only do that if they could directly transfer capital to individuals and control their spending, either by forcing spending, by having expiration dates, or restraining spending, where you can only buy meat Monday, Wednesday, and Friday. So that's exactly what they want to do with the capital controls offered by CBDCs. So you'll see that. I would have in 10 years you'll see it. In 5 years, I wouldn't be surprised if a lot of countries around the world uh, don't execute on that type of financial capability. It'd be strange. Now, the U.S. clearly we're going through a strong bullish dollar moment. And when the dollar is bullish, it puts a lot of pressure on risk assets, and risk assets, the stock market and the crypto space is basically zero in size. And the stock market is basically zero also in the global financial system. Every single stock around the world is microscopic as compared to the size of the derivatives market, and the derivatives market is small compared to the eurodollar market. So these are extremely small markets we're talking about. The stock market is a small market. It's just a wild thought in so many regards. So over the next 10 years, you can see drastic changes in the stock market, and that's just hard to imagine what that becomes. I mean, obviously, folks have talked about the digitalization of stocks and equities, and if you're going to digitalize a stock and equity, you're in the same realm as like why countries would want digital currencies. Because if you could digitalize a stock or an equity, you basically get to build what we built in DeFi, where you have a capacity to issue stock, you have a capacity to burn stock, you have a capacity to turn stock into monetary policy. It's exactly what we did in DeFi. Everything we do in DeFi has overtones of currencies, stocks, equities, has current overtones of bonds. There's plenty of debt issuance. There's technology like money markets and forex markets, and synthetic products. We have options and derivatives all over the place. So the best way, I'll end this point on, the best way to understand these markets is to compare them and model them as you would look at legacy financial products, services, and infrastructure. And everything that's really been done is metaphorical or comparable to these historic systems, uh, but so much more powerful. There's so many overtones of MMT in the DeFi space, which is how we really get a sense of how a dystopian CBDCs can get. Because what do you think VE locking is? It's called a capital control. You have transferred your rights to a third party. You no longer have a capacity to liquidate, and you've exchanged it for a revenue stream. So there's an overtone of UBI, but it also has overtones of business ownership and venture capital. So it's just a fascinating mental thought experiment to try and digest all this shit that we just experienced over the last 2 years in the context of legacy finance, of the likely future finance, and try and paint the picture of it. Then, to top it all off, try and tell someone in your family this story. I have a difficult time telling you folks who are deeply involved in the crypto space this story. Try telling cousin Joe, who, which is, I say that because I was talking to some family last night, and that's always an interesting experience because I can't say the things that I'm telling you. Nobody would understand this stuff. So I try and put all these things we talk about on the daily in terms that the general public, friends and family, would understand. And really, the best way to describe it is business and venture capital. Quite extraordinary. One curious view, Michael's Saylor, 100% conviction on BTC. That's cool. That's cool. I mean, Bitcoin holds, there's 3 points I can make about Bitcoin. One, Michael Saylor is on point from a billionaire perspective. How else are you going to carry that kind of capital for the next 100 years? Two, Bitcoin's great for savings, people that have no comprehension of investing whatsoever, yet alone the crypto space. Yeah, you DCA in the Bitcoin. That's a great way to save. You used to do that with gold. You could do that with gold. In the next 10 years, you'll probably, gold will be worth more. Which one will you outperform with better is probably Bitcoin. But you're not going to significantly outperform, meaning you're not going to elevate your status from like lower class, middle class, upper class on Bitcoin. Bitcoin is not going to produce those kinds of returns. You have $10,000 worth of Bitcoin. Yeah, you maybe get a 5, 10, 15, 20x on Bitcoin. You're not retiring off a 20x on $10,000. So Bitcoin is not going to achieve what a lot of people that invest in Bitcoin hope to achieve. Um, and the third point I guess I can make about Bitcoin is not related to an investment. It's just acceptance of reality. So many folks you'll see on social media talk about Bitcoin as being deflationary. It's not. It's inflationary on the short term with 4-year cycles of disinflation. And I find it strange that it's not talked about the way I just described, because the way I just described is actual technological reality. I think people just regurgitate facts and don't really make assessments for themselves. Like Ethereum is straight up disinflationary, and it's going to become deflationary. So the monetary policy is quite different. The consensus mechanism is quite reasonably a contentious debate, but that's besides the point from the monetary policy. If you reduce all this shit to monetary policy, you have a common denominator for evaluation. If you reduce everything to a business balance sheet, you have a common denominator for evaluation. Is it cash flow positive? How much dividends are they giving to their investors? Now, Curve's cranking out some nice dividends. Let's take a look real quick. I mean, Curve's cranking out 5.25%. Imagine a stock, a 4-week average of 6.29%. Literally, my Curve pays me half of an average salary. It was 60 grand a year, would be pretty much an average U.S. salary, and Curve pays 27. And if you have a bunch of protocols that add up, you have a couple of salaries, and that's pretty cool. That's pretty cool. 5.25%. I mean, that's a wild number if you're looking at stocks. And this thing's cranking out 5.25, but it's not 5.25 because the bribes are cranking out 40, 50%. This is just a wild protocol. Wild. And I don't like saying wild. I don't like expressing my high opinion of protocols. I need folks to make their own assessments. Anyway, you guys know why I say things like that. Do your own due diligence, I guess. 54 people in the stream, 17 likes. We can do better. Dan's in the house, a pleasure. I'm missing a couple of comments. Let me try and find it. Do you have any insight regarding Forepool and it being on the FTM network on Curve? Probably, if not now, probably inevitably. Warren, what's up? What's up? How do you see Stargate having an efficient cash flow protocol revenue? Yeah, it's quite expensive, actually, some of the transactions. It's like 50 something Phantom, 60, 70 Phantom at times to do a swap from Phantom to mainnet. So it's a little pricey. So obviously, that's probably contract fees, or maybe I don't think that's entirely transaction fees. So I end up using multi-chain still to go cash from Phantom to mainnet. I don't know how that's going to play out. I know Layer Zero is big tech. Cross-chain messaging is big. Multi-chain got into cross-chain messaging, and there's a couple of others that are in it. I look forward. I'm going to work with the Stargate folks on their monetary policy for STG. Now, it's not going to be like full time, but I'm going to give my insight and encourage them to be cash flow positive. They need the deflationary pressure on circulating supply of the asset. You probably want it to be deflationary, albeit inflation is powerful, as Curve has turned inflation into basically a very powerful machine. But no one else is spinning up a Curve mechanic. So most protocols and governance assets really need to be net deflationary, kind of like what Frax does. Frax literally pays people incentives, the bribes, and all the LP incentives that they directly do with Frax that they purchase. It's a net deflationary protocol. The monetary policy of Frax is absolutely wild. Citadel seems like 3.3 v 2.0. Not at all. It's not 3.3 at all. You got to look over the monetary policy of Citadel. It has no overtones whatsoever of Ohm, of Olympus DAO. The monetary policy is quite distinct. In fact, it has a superior dilution prevention mechanism than Solidly. So Citadel really ticks a lot of my boxes when I look at its monetary policy. Joe, this is a way different narrative than the pizza shop and avoiding capital gains. Well, what do you mean by that? Because the pizza shop is something that I do believe is still valid. Like we well, VC, you own a business, or the pizza shop is a business, and it pays you weekly. And I have plenty of positions that I can't liquidate, so I own these businesses. I can't sell them, and they generate revenue, which I could use to pay credit card bills, so on and so forth. So I think the pizza shop is still there. So I see your point. Maybe the pizza shop that I originally talked about in capital gains, the story I tell nowadays is much more robust, and it really, it'll continue to evolve. There's no way it's stopping now, but we have all this context and all this history we get to draw on to tell these stories. So I guess in that regard, we've evolved, we've iterated on the stories we tell. We've been through a lot, Joe. It's been a wild ride the last 2 years. Dan, a pleasure. Liv, there's not much to talk about right now. I feel that. Yeah, it's been a obviously a lull in the market when endorphins aren't flowing and stuff isn't ripping 10x on the weekly. Captain, I tried to tell folks, come listen to you because you tell it straight. These markets are not for the weak hands, not too much teaching like this in the space. These markets are ferocious, they're predators. Uh, and, my comfort watching assets be volatile really just comes from experience. And I look at this bear market, I'm like, all right, these guys are going to push the market down again. We're going to see 50% or whatever the hell the retrace is going to be. All right. So what am I looking for? Why am I comfortable? Because I've identified lindiness. I've identified technology that will continue to exist in the future because it has existed thus far. And I've concentrated the portfolio in assets, which I model as businesses, that are more likely than less to exist into the future. For what reasons? For reasons of balance sheet health, cash flow, being cash flow positive, and very rational monetary policy. And the monetary policy evaluation we do is based on the history of central banking, the current status of fiscal conditions of various countries, sovereigns around the world. So that's me responding to that statement. I guess we've had fun teaching, but man, you guys help me just as much as I hopefully help you guys. Those likes, y'all. 56 people in the stream, 22 likes. We can do a little bit better. We've done better thus far, but we could still do better. Would 100% pay money to watch your stream? Sure, I don't mind. I do this, and I've capitalized a little bit. The Discord has a premium, but I don't want the streams to be paid. I want this to get out there, and I have my philanthropic side, and I need to help people. People can do better. That was one of the original hashtags we came up with. We can do better because we need to do better. People deserve to do better. People deserve to be able to attack the crypto space and peer through the madness and see what it really is. And there's real tech here. And it's not emotion about um, Ponzi schemes and hope to turn $1,000 into $1 million. That's all hopium. What we do, what I do, what I've tried to teach everyone is to see from an engineer's perspective, from a programmer's perspective, that these protocols are extremely smart. The algorithms are extremely sophisticated, and the power of these protocols is the manifestation of assets that have characteristics that span very wide ranges of use. Historically, you have to look at this stuff as assets and commodities, and model them as businesses, and look at them as currencies, and analyze the monetary policies. That's just wild. Just wild. Um, do you have any books, resources, recommendations on gaining a deeper understanding of monetary policy? Realvision.com. It's not going to be specific, but they talk a lot of macro. Monetary policy, just you got to look up central banking, look up terminologies like inflation, deflation, look into uh, the proof of work consensus with Bitcoin and the cycles, the halving cycles, and look into deflation with what Ethereum is going to become. Look into the Curve monetary policy. Got to digest that one. This thing's extraordinary. Curve is a hyperinflationary protocol that technically is disinflationary over time, but because of the federation of protocols that are mandated to put it in reserves, Curve is either net disinflationary on the short term with very transitory periods of deflation. It's basically a barely inflationary currency that emits a huge amount of new currency into circulation on a daily basis, but almost all of it is consumed merely by convex. If you look on convex Discord, you'll actually see that the vast majority of Curve emitted daily is consumed by convex, if not by the federation of other protocols that are mandated to put it into reserves. Quite wild. And the only thing that I could possibly compare that to is the dollar and the supremacy of the dollar as the reserve currency. But current countries have to put it into reserves, and that's what they've done. And there's a constant demand, there's a constant buy pressure, and that's what's been playing out with CRV, and that's quite wild. Um, I am not interested in GMX, Dan. I'm not interested in Yeti Live. I'm not interested in anything really in this market. Yeah, GMX is cool because DYDX has just shitty tokenomics. I mean, I don't understand why anyone buys that garbage. And I know the deal with GMX. It doesn't tick my boxes. It's a structured product, derivatives, options, so on and so forth. It's big stuff, but it doesn't tickle my fancy. Like if the only thing I'm thinking about was CTDL, Citadel. I'm part of the knighting round, so I'll get an early position in that. I have that. I bonded with Stargate, so I have that 25 cent, cost basis position that's locked for like 5,000 years. I took the Rook position. Um, that's because of the massive tokenomics pivot. It's deflationary, and the cash flow is from MEV, minor extractable value. So that's crazy. So everything I do is methodical, and I just can't justify a GMX position. It doesn't tick the boxes enough. That's basically my sentiment. One curious view on Citadel, not a criticism. I refer to elastic emissions and treasury funding aspects of the tokenomics. Yes, and that's what catches my fancy. Uh, those characteristics of the monetary policy you're looking at, look how they play into the dilution protection offered to the CTDL. Was it XCTDL? And then you have vote lock, VLCTDL. Take a look at the dilution protection, and that's what caught my fancy. I hope that I clarified what's not to like, Dan. It's not that it's not to like. I do like it. It just doesn't tick all the boxes. What do you see the best use case for Layer Zero tech? Layer Zero is cross-chain exchanges. I mean, the proposal with Sushi Swap is exactly really the potential. You could have an exchange user interface and swap from any chain to any chain. And Stargate is real as a manifestation of that with regard to a bridge implementation. But really, Sushi Swap can take Layer Zero and make a seamless cross-chain DEX. And here's my December narratives that are still up. Seamless cross-chain interoperability. Woo! Papa Bear nailed those 2022 narratives, and this probably still has a Q3, Q4, Q1 2023 time horizon built in. Disintermediated protocol managed arbitrage, cross-chain liquidity provisioning, MEV mitigation, and capture systems. These narratives were early, but there's a Rook position with the MEV mitigation and capture systems. This is really like a protocol managed arbitrage, cross-chain liquidity. That's like a popsicle or a ring. They're not there yet. Like Q4. I'll check back early 2023 or like November, December 2022. But they're not ready yet. But seamless. It needs to be seamless. Put in USDC on Ethereum, and a protocol puts that Ethereum on any chain and captures revenue, 20, 30% of revenue from all chains and every chain. It just does it automatically. And seamless, trans- transparent, black box cross-chain liquidity provisioning. So we're not there yet, but Rook really stepped it up with their tokenomics pivot, making it deflationary. Now it's depreciating. Everything's freaking depreciating, but the narrative and the pivot. I mean, how could I argue with it hitting literally my 2022 narrative? So this is an interesting one. This is the curve monetary policy. I was hoping for solidly to really be a manifestation of what I was thinking here, but they're going to relaunch it. There's probably going to be a shitload of forks and actually fix all the shit that Andre messed up. But Beats kind of hits on this, and it's the concept of having an inflationary asset with monetary policy characteristics that balance with deflationary pressures, be it vote locking, be it bribes and gauges, so on and so forth. But what's necessary with that kind of protocol is federation. So it's not just vote locking. It's not just having balanced monetary policy with deflationary pressures. You need the federation of protocols that are mandated to put the asset on its balance sheet, in its reserves, and that's what creates the dollar effect, where there's constant buy pressure, and that's quite extraordinary. So curve convex, obviously the root of the curve narrative on Ethereum mainnet, but they're branching out to other chains. So folks often look for like the disruptor. So what's the next curve? No, there's no next curve. Curve's the next curve, and you might have a lift. So you understand the analogy, Uber, and then has the lift. Lift's not going to disrupt Uber. The next curve isn't going to disrupt Curve. Um, you'll have you'll have competing protocols over time, but once you have momentum, you have a moat, and the lindiness is there. So unless there's like a complete catastrophic failure of the entire system, Curve will remain in the lead, and that's what these types of systems do. Look at Microsoft. Everyone thinks Apple overtook Microsoft. No, they didn't do shit. Microsoft still completely owns business and enterprise. So Apple has never, ever, ever, ever disrupted Microsoft. It doesn't matter if Apple's the largest corporation in the world. Microsoft still completely owns business enterprise. So they were never, ever disrupted. They had a moat. This is why we talk about moats. Moats are almost impossible to disrupt. Last question, and we'll wrap up the stream in a couple minutes. If you had a chunk of capital right now, would you hold off investing or DCA? So I was having this conversation with friends and family last night. Now, I can't honestly say allocation to Bitcoin is going to be lucrative, but allocation to Bitcoin is good for savings. So it depends on a person's mindset, a friend and family member's mindset. It's probably more likely that Ethereum will outperform. So DCA into Ethereum is interesting. It also depends on the person's age and how much capital they're working with. If they're a relatively wealthy family member, sure, DCA Bitcoin. If you're satisfied with 10x over 5 years, DCA Bitcoin. But if you want 100x, you're probably going to have to branch out into VC and venture capital in the altcoin space. So the way I would do that is probably like DCA Ethereum, and I would taper it, meaning I would have smaller allocations to Ethereum now because this market looks like it's going to completely collapse. But just because the market looks like it's going to completely collapse doesn't mean you don't allocate. You just allocate less, and you build the position more as the market collapses more. You DCA more as the price continues to bleed. If you had come on, if you allocated capital in March of 2020, you made 20x on your money just on Bitcoin. Wild. I mean, Bitcoin ripped from $3,500 to $60,000 between March of 2020 and the top. So you want to buy more when the market looks like it's completely devastated and collapsed. So you DCA slower now, $5, $10, $20, $50 a day, a week. whatever you feel most comfortable with. And then as the market bleeds, Ethereum gets to 2,500, 2,200, 2,000, $100 a day, $150 a day. I don't know, whatever your budget allows, but you start slow and then you build more, slow and more as the market bleeds out more and more. And then you get, as the market starts to rebound, you'll see it with Ethereum. It'll stabilize and start to do the crab walk horizontal at the bottom, and you see that in the chart. You'll see. Let me show you real quick. That's Bitcoin. Let's look at Ethereum. So there's your crab walk. That was a 2-year crab walk. Oh God, it ranged from $74 up to $300. So it's still volatile, but it's still crab walk for months on months. But that's where your dollar cost averaging. And then you get the multiples. Then you get a fat multiple up to 1,000, 2,000, 3,000 from $200, 20x on the money. You have to sell. So you know it's going to come down. Anything that goes up comes down. And Ethereum, I don't think it's not. I'm not a position I'm too interested in at the moment. But you could easily get nice multiples if the market collapses enough. You got 15. Like if you got a Ethereum collapse to $1,700 or even here like a $1,300, oh, that's golden. I mean, you'll never see these. If you see these 500s, yeah, even I'll throw in 100 grand into that. Jesus Christ. It's not the cash flow generator. The future analogy, the 2030 time horizon perspective on Ethereum is like a bond of some sort. I mean, sure, if you put in 10 grand and it turned into like 5 million, and you get a 5% on your money, 3% on your money, or whatever Ethereum POS nodes are running at in 5, 10 years. I mean, that's nice. 5% on $5, $10 million. That's a nice revenue stream, but it's going to be not as productive as other businesses in the crypto space. So DCA Ethereum is probably a decent recommendation. What I did for friends and family last night. A wealthy person, probably Bitcoin. Older persons are another story. If you're in your 40s, 50s, and 60s, you have to have a diversified portfolio. It can't just be crypto. You're going to want some stocks and bonds. You're going to want probably some property. Probably buy a business. I mean, we're talking about modeling these assets as a business. I mean, businesses are a great idea. Buy a damn pizza shop, an actual real pizza shop. So we're talking about the pizza shop analogy, but I'm talking about a pizza shop right now. It's not a bad business. Anyway, I hope that helps, guys. Hey, no, is convex Lindy moated? Well, convex is what stabilizes the curve monetary policy. So, in most regards, yes. What'll likely play out with convex is a transitory shift between curve and convex with regard to bribes. As the capital flows to curve bribes, more opportunity will present the convex side, so the capital will flow back and forth between the two bribe systems. That's most likely what's going to play out. I got no crystal ball, but that the gut says that's most likely the flow of the way the systems will progress over time. I hope that helps, guys. 54 people in the stream, 30 likes. We did better. Thank you all very much for joining on a Monday, April 25th at 1:07 p.m. As always, feel welcome to join me next time, Wednesday after party on Discord, where we're always talking, the most rational community in the entire crypto space. All rational, all the time. NoahSimon.com. If you need any one-on-one help, more than happy to throw something on the calendar. I will see you guys Wednesday. Peace.